Focus. Ideate. Innovate. Enable.
UTI Mutual Fund and CNBC TV 18's Financial Advisor Awards, one of India's most esteemed awards to recognize the role of independent financial advisors, is now in its 7th year. In today's economic environment, where investors are exposed to multiple investment options, an independent financial advisor plays a critical role when it comes to creating and preserving wealth and distributing expert and productive financial advice to investors.
Whatever happens, you must stay invested through the cycle. Part of the role of a financial advisor is to act as an emotional counselor as well as a technical advisor to keep fear and greed within boundaries.
Each year, the Financial Advisor Forums reach out to independent financial advisors in different cities across India to discuss investor issues, challenges and the way forward for them, with experts from the advisor community who advise, debate and deliberate on various issues plaguing the wealth creators of the country.
What I find is a direct correlation between fixed income assets and the size of the assets of the industry. So if you look at a Mumbai, because of a large corporate presence, a Delhi, a Calcutta, Chennai, and I contrast it with, let's say, a Bhubaneswar, what I find is the fixed income assets as a proportion of assets, overall assets, are pretty low.
Financial advisors are essentially managers of expectation of a client's emotion. So all a client expects is that when things are good and things are not so good, somebody should talk to me, somebody should handhold me and explain me the situation.
Are you able to reassure? Are you able to educate? Are you able to help him deepen? Are the core pieces where the engagement defines the trust and the confidence which you're able to build in the retail investor.
This year, we kickstart the 7th UTI Mutual Fund and CNBC TV 18 Financial Advisor Awards 2015-2016 with a power-packed interaction between Latha, Ventakesh, the Executive Editor of CNBC TV 18 and the MD of UTI Asset Management Company, Puri.
Hello and welcome to this very special interview we have with someone whom the markets would definitely want to hear at this juncture. I have with me Mr. Puri, the Managing Director of UTI Mutual Fund. Thank you very much, Mr. Puri, for joining us. Well, we meet at a time when the markets have seen too much by way of tumult. Has it now started also hurting the small investor? Are we beginning to see the jitters even in SIP flows as far as funds are concerned?
Yes, I think it is actually quite concerning, and I have of course heard many people say, don't worry, it's a buying opportunity, and whether or not that's true I can't say, but I have some empathy with investors who have essentially lost all the gains of the last 2 years, other than the obvious rule that you keep systematically investing and that the fundamentals don't suggest a reason to panic. Whether or not this is a good time to be making lump sum investments is entirely a function of risk appetite. It is, in my view, a risky time to be making lump sum investments, but it could turn out to be a very good time because obviously risk is correlated with reward. So if you have the risk appetite and you essentially have the allocation capacity towards equity, then perhaps for you, if you're that profile of investor, that's probably not a bad thing to do. But if you are a fully allocated investor where much of your savings are already in the equity markets, it's best to sit tight, not panic, and use a systematic approach at this stage.
As a long-time watcher of the markets and the economy, what is the sense you're getting? Is a level of irrationality setting in? Are you getting a sense of capitulation and therefore maybe the selling can't go on for too long?
I read a term today which I quite like, which is reflexivity. The market, in a sense, looking in the mirror and getting frightened of itself. And as they say, all you have to fear is fear yourself. So in the very near term, you are seeing this issue of reflexivity. And we also know how interconnected markets are today. Currency markets are connected to fixed income, equity markets are connected to derivatives, and you've had such volatility across currency, fixed income and cash equity markets that you can just imagine all the algorithmic sort of red lights going off all over the world. and getting triggered even more so. And that's the element of reflexivity which takes you beyond fundamentals. And that is certainly happening. At this point, I think we do understand, it's been well stated that as far as India is concerned, we have the ability to hunker down, if you like, for a bit and are better positioned to weather the storm. I think that's true. But again, I wouldn't be so complacent as to say that there are not real underlying structural adjustments taking place in the global economy. The trigger for this immediate bout was the fear that perhaps rates may not indeed the rate rises may not be held back. People were desperate to hear from Yellen that yes, we're back to a world of easing. The moment she took that crutch away, it appeared as if essentially you ended up with this reflexivity. The market started to, in a way, start cannibalizing themselves with fear at that point. And that is troubling because it shows that most market participants are aware that there could be a period of painful adjustment at some point down the road, and we have been postponing that.
Appears now that the markets never read the commodity fall correctly, and that the commodity markets were telling us there is a recession. Is it as scary as that? Is that the reading?
I think people understood what the commodity markets were telling us, but because you essentially had easy money in the background and not very many places to put the surplus, you did have the asset bubble, as has been observed for a while. So I think, yes, it suddenly dawned on us that we probably do have a global slowdown accompanied by a possibility of some amount of monetary tightening in the not too distant future, and that is a cause for concern.
We are coming back after a very short break with questions on what the budget should look like and on the expectations on the reform front in a minute. Welcome back to this special interview with the Managing Director of UTI Mutual Fund, Mr. Leo Puri. Well, Mr. Puri, the budget. There are some talk, rumors if you please, leaks if you please, from Delhi that the government is seriously considering long-term capital gains tax on equities. That exemption will perhaps be taken off. Can that be extremely troubling for the markets at its current juncture?
I think at this juncture it would be quite troubling. And you also have to remember that STT was introduced precisely to compensate for that. And you certainly couldn't have both those two in place at the same time, that you're both offering capital gains tax and you're offering STT to the government. So my own expectation is that this is probably not the right time. Although I do understand the desire to essentially normalize exemptions, by the way. I think that's the right thing to do. We have too many exemptions and too many oddities in terms of the way we build our budgets. But I don't expect this change to happen at this point in time.
One of the things that's been going for Indian equity markets is, even as the FII sold off, you had the domestic investor putting in money, and therefore the DII element was a good counterweight. Is that in threat already, and will it be under greater threat if there was capital gains tax?
Yes, I think that could get impacted in the short term. I think we already, as I mentioned at the outset, have a group of investors who will be feeling under stress, having watched their entire gains, hypothetically, potentially, actually evaporate at this point. Now, we are, of course, counseling them to stay put, and the India story, as we discussed, remains incredibly positive at this point. So all in all, we have to do everything to keep flows coming in. We do get about 2,500 crores as an industry of SIPs, and one of the achievements in the last year has been to encourage people into the systematic investments, and thank God for that. It's not a huge amount, but it will provide some support to the markets going ahead.
Let me get a few things from you on the banking sector. Do you think that it was right on the part of the government, and more particularly the Reserve Bank, to force a cleanup of bank balance sheets?
Absolutely. I think the asset quality review and the push towards a cleanup of balance sheets is long overdue. It's absolutely the right thing to do. The only observation I would have, perhaps using the medical analogy that Dr. Rajan was using, is that if you decide on major surgery on a patient, you also have to have the patient and the family, if you like, involved in that decision. So we're going to surgically operate on the public sector banks, then the banks themselves, and in a way the broader ecosystem, which includes the government, must know what to do with this patient when it comes out of surgery. You're operating on a sclerotic, overweight patient that is not very productive at this point, unable to lead its life, if you like, in a sense. And it's a marginal decision whether you leave him alone to kind of eke out his days or whether you intervene. If you intervene, and I believe it was the right thing to intervene, everything else has to fall into place. Now, we've already laid out what that everything else is. It's called Indradhanush. And Indradhanush is a very well-architected plan. It has recapitalization at the heart of it. It has a process for bringing in performance and accountability, and it has governance as well. It also has a mechanism through the Bank Board Bureau and the eventual shift to a holding company, which will allow for capital structure and long-term reforms. The one thing that is missing, perhaps, is timing, urgency, and in a way, ownership. This is an initiative which needs to, I think, be owned in a way by the Prime Minister's office. It goes beyond the Ministry of Finance. It's really a matter of national priority. It has a huge impact on our ecosystem at this point. And having started the work of surgery, if we don't follow through, then we would look back and say it was possibly the wrong decision. Because you cannot initiate major surgery without essentially having thought through what follows next. And as I said, I think we have thought through what follows next. We just need to act on it now with, if anything, enhanced urgency. And so I certainly hope to see the capitalization come in very quickly. We should have another 25,000 crores by April, 5,000 this fiscal, 20,000 as soon as we can in the next new year. And all the other elements of Indradhanush then. The Bank Board Bureau needs to be in place because that is what is going to guide the transformation and ensure that this doesn't repeat itself, and so on. So if we get that right, we'll have done this country an enormous favor. And I think the pressure that's been put through the AQR is a very welcome catalyst. But I have to caveat it by saying all else needs to follow too quite quickly.
Let me take a break and come back with lots of questions to this veteran mutual fund industry expert on where is that industry headed. We're back in a minute. Welcome back to this special interview with Mr. Leo Puri, the Managing Director of UTI Mutual Fund. Well, Mr. Puri, the mutual fund industry itself, some efforts were made by the regulator and by the industry to expand its geographic reach. The B15 rule, trying to reward distributors in outside the major 15 cities, as well as the money set aside for educating investors. Has all this worked? Is geographical spread really improving?
Yes, but more slowly perhaps than we would have liked. But the good news is it is improving. In fact, in the very recent equity rally, we did see some expansion, a few percent expansion, and at least some of us are quite committed to building that out. I think the other issue is that retail participation should also be coming through pensions and retirement and so on. And I think the failure of the NPS to catch people's imagination has really slowed down their willingness or their ability to come into equity markets. And I think that's a pity. So as soon as we can also fix, if you like, the issues related to the attractiveness of NPS, in addition to the efforts the mutual fund industry is doing, you'll see retail household participation in capital markets rise very sharply over the next decade.
I wanted to know how you see the evolution of the financial advisory community itself. I mean, you engage with them very actively through the Financial Advisor Awards. Have you seen the community evolving both in terms of its quality and in terms of its quantity and reach?
Well, the distribution community has, in terms of its size and position, been somewhat stagnant, and that's actually a worry for us. So just in terms of reach and presence, it has been of concern that we have about 70,000 sort of registered distributors, of whom maybe 10-15% are really very active at this point. That's clearly not enough for a country like ours. And while of course we are witnessing direct and technology driven initiatives as well, they're clearly not enough to actually compensate for this. At the same time, there are historical biases, prejudices, perception about the quality and the usefulness of the role that advisors actually play. Our own view at this point, taking a balanced perspective, is that there's going to be a very large segment who will not come into the capital markets unless they actually have, in some shape or form, a trusted advisor, both to explain and initiate and educate them into the product and then to guide them through it. And actually there are many such people who exist. In fact, it's only a few relatively bad apples, if you like, as is the case everywhere, who tend to give them a bad name. So we must focus on how we can find ways to positively encourage that and create the economics for that. The regulator in previous years was actually quite helpful, and I think helped build a platform for us to do that with B15 and with allowing fungibility and so on. All of that has allowed us to share rewards with distributors to keep them in the business, if you like.
On the one hand, expansion of the committee of investors requires that the advisor should be adequately compensated, the distributor should be compensated for relatively small ticket investments, which becomes a little difficult for that investor, because you have to ultimately take some of the load to be paid by the investor. On the other hand, the investment community itself is not extremely well qualified. It has its own questions to answer. How can incentives be structured in such a way that the distributor is tempted to go to the small ticket guy?
Yeah, I think at the moment the approach we have is we have a direct plan, and we have, of course, a regular plan. And for those who are sophisticated and wish to come and are confident enough, they can come through a direct plan. But the direct plan is actually not suitable for everybody. There is definitely value to good asset allocation, which is the primary role a distributor plays. And there's a lot of value to actually being guided through a life cycle by a trusted advisor. It can easily compensate for the few basis points differential. And that's a call different segments of investors should be free to make. We are agnostic as a manufacturer about that. But there's also a push currently, which is a little more controversial, towards forcing, in a way, the industry towards a pure advisor model, where you will charge the client a fee. And that's an area of a lot of debate amongst distributors. Again, my view is there is a segment of clients for whom that is the right model. The high net worth clients, the family offices, the more sophisticated clients are absolutely ripe and will benefit from a process where they pay the direct plan and they pay a fee, transparently negotiated across the table with their advisors for the value they're getting. They can sleep well at night knowing their advisor is working for them and not pushing products or for anyone else, because they're paying them. And frankly, we pay for everything. And we pay for lawyers, we pay doctors, we pay for a haircut. Why wouldn't we pay? It's another service. Why would we resist? So I think we would accept that. I would accept that, and I'm sure so would you. But then, as you say, there is a group of people who are just sort of in the middle, who are not high net worth individuals, who are mere retail investors, and who may well balk at this model, or the ticket sizes may, as you say, be so small.
So small that the distributor doesn't find it attractive.
That's where I think what many countries have found is, instead of a pure advisor model, you have something called a suitability model, where you essentially create a set of regulations, which we have done for the most part, around what constitutes mis-selling, what constitutes needs identification, and then having established that level of investor protection, you continue to have an embedded commission, if you like, which compensates for that. And since we've taken steps to anyway cap overall commission, since we have put in place a number of measures to ensure that mis-selling is contained, perhaps more rigorous follow-up and monitoring of what we already have on paper, if you like, would be sufficient to create a suitability standard where people would be well served and well protected. I think we have to develop that idea a little further to make sure we don't lose retail penetration in the country.
Okay. The mutual fund industry has had its best past 2 years in terms of inflows. I believe the inflows just over the last 2 years were more than the inflows over the previous 8 years, which is
decade, I think, yes.
Yeah, previous decade. So what can ensure this continues? Will the stock market tumult puncture this excellent record? Can the record continue in spite of the stock market gyrations?
We certainly hope so. So I offer two thoughts there. One is that we have seen much more resilience thus far. And of course, we're going through the extreme points of pain right now. So I hope I don't eat my words. But till this point, we have seen remarkable resilience on the part of retail investors. We will see some level of questioning around that, but I'm hoping that that fortitude will continue, given the good news we discussed earlier on the Indian economy and what we expect to see on a macroeconomic and reforms front. The other point to make about capital markets, of course, is debt is a very important component of this. We haven't talked much about it, but it is a very important part of their asset allocation and for us as an industry. And debt will continue to offer fairly attractive returns for investors. And so to some extent, you may see some reallocation again between fixed income and equities, which, by the way, I don't think is altogether an unhealthy thing. It should happen at points in the economic cycle. And I hope that we'll see people staying in, if you like, in the capital markets. Because from the country's point of view, as long as households are essentially supporting both debt and equity, depending on their views on the economic cycle, it would be a good thing. But this resilience has been very heartening. The last thing I would probably say is the need to continue to strengthen domestic institutions, because we all know that we have only LIC as a major domestic institution, and that is worrying for an economy the size of India. And that the same energy that we have shown towards thinking through industry structure for the banking system, I think we now need to apply thinking through the asset management and capital markets players, many of whom are anemic, not all of whom are uniformly governed. There are questions about how the industry is structured, owned, operated, capitalized, and again, without prejudicing the outcome or perhaps revealing my own biases entirely on that, there's a very ripe area of exploration for policymakers as to what interventions or what catalysts are needed to ensure we have a healthier set of institutions in the domestic arena for capital markets.
Thank you very much, Mr. Puri, for joining us in this interview.
Thank you. Thank you, Latha.